This is a good opportunity for us to start talking about inflation and specifically CPI. This is consumer price inflation. Economic announcements in general actually tend to go in kind of fads, if you will, where traders will pay a lot of attention to a particular announcement or what have you for a few years, and then it kind of fades in emphasis and another one emerges. Well, back in the early 2000s, CPI was what it was all about. So everybody was watching CPI, and there was a reason for this. Now, gradually, it kind of lost some of its emphasis, and NFP, or payrolls, and unemployment began to emerge as the big announcement every month. Now, I'm noticing a bit of a shift, and there are other announcements that kind of come into vogue or go out of vogue. And I'm noticing lately that there has been a renewed emphasis on inflation numbers, and I think this is going to reemerge as another emphasis on CPI. Now, why is it that traders are interested in inflation in general? Well, it all goes to, there's this cycle in the market, and it goes with, it starts with growth. If you have economic growth in an economy, then you have something else that will occur, because growth generally creates higher wages, more full employment, etc. Well, as those wages and employment are injected into the economy, you get inflation. Well, this is not necessarily a bad thing in and of itself, but as long as it's kept within a moderate level. Well, the issue is that inflation, if it begins to escalate too fast, which is somewhat ambiguous, it's a nebulous concept in and of itself, it begins to mess with asset values. So it really reduces the value of assets out there, and that can be a real problem, such as, for example, savings. It can be a disincentive for the consumer or the population to save, which is largely one of the culprits of the problems in the United States right now with a no savings rate or a negative savings rate because of this inflation problem. They've been disincentivized from doing that. Now, this inflation, in order to control it, creates another cycle where the Fed, or the Federal Reserve in the U.S., is charged with controlling inflation and trying to make sure that it doesn't go out of control while still maintaining growth. So they're trying to balance these two forces here, that when one goes up, typically the other one goes up as well. Well, so they're oftentimes joined in periods of economic expansion, and the way in which they'll do this is that they'll adjust interest rates. So as interest rates are increased, it curbs growth a little bit because it makes expansion and growth more expensive. So it kind of reins in the economy a little bit. So what traders will look for is higher rates of inflation, indicating that the Fed is likely to raise interest rates to control growth. So now, if interest rates are going up, that means the yields associated with a particular currency, in this case the US dollar, is also likely to go up, and that increases the value of the dollar. Sounds pretty simple, right? It's just a matter of kind of following this chain of events. There's a couple of big problems. Okay, let's talk about the three big problems with CPI, which is probably, next to the non-farmers payroll report, my least favorite economic measure because it is so misleading. The first is, of course, that the measures are very subjective. So let me give you a couple of examples. Basically what happens is CPI is a basket of stuff. It's all these kinds of things that consumers may be spending money on. It's a big basket. And that basket, so that it accounts for 100% of the prices that the U.S. consumer is paying. And each one of those components of that basket, whether it's corn prices or soda pop or whatever it is given a specific weighting based on how much money is being spent on that particular asset within the basket. Here's the problem. This measure is very contrived. So, for example, healthcare is weighted to be about 6% of the basket. So healthcare is about 6%, but healthcare itself is estimated by pretty much everybody as being at the very least 14% of GDP. So how do you reconcile that? It's only accounts for a small percentage of the CPI basket, and yet is a fairly major percentage of GDP. There's other funny things. Everything is weighted a little bit weird. There's other funny things that go on within the CPI basket, from health insurance or health costs here as an example, haircuts, and then club fees. So, for example, if you belong to a golf club, are weighted equally. I think that most U.S. consumers pay for haircuts, don't pay for club fees. I think that that equal weighting there is a little unusual and can skew things. Women's underwear is weighted at 0.5%, whereas men's underwear is not rated at all. Funny thing is, pork chops are weighted, so I think we're taken care of there. The point is that it begins to, these breakdowns and weightings begin to get a little absurd, even a little bit funny. The second problem is there is this disagreement between CPI itself, which includes food costs, energy, and core CPI, which excludes food and energy. Now, why would that be? This is the subject of a lot of debate. I mean, if CPI in general, including energy and food costs, is rising excessively, the U.S. consumer doesn't have a choice about whether they only pay for core products or whether they pay for all products. So you get these problems of price shocks can be ignored. So, and what do I mean by that? Well, specifically, one of the things that the U.S. is experiencing right now, where we are having a significant price shock in some of the CPI measures like oil, for example, food, for example, and it's not being included in core CPI. So what are regulators using? What are investors looking at? And it creates these dual measures that don't reconcile with each other very well. In fact, price shocks can be so extreme, which is something that we're experiencing right now, that even though your inflation numbers are rising, it does not mean that growth is rising. So sometimes these price shocks can really break this relationship here. And then what does the Federal Reserve do? So their traditional basket of tools to control monetary policy and to try to streamline the economy are completely broken because this relationship doesn't exist anymore. Well, that's what's happening right now. So we have this weird situation where, and a lot of inflation measures, by the way, have this unusual caveat between, or exception, where they try to exclude things that are too volatile or are outside, are statistical outliers or what have you, and yet can have the biggest influence on this whole relationship, such as what's happening right now. It makes managing monetary policy extremely difficult. Finally, number 3 is CPI is not a apples and oranges type of thing. So, or rather, it is an apples and oranges thing. So, for example, CPI in the U.S. is not equal to CPI in the Eurozone. So, consumer inflation in the U.S. does not equal consumer inflation in China. It does not equal consumer inflation in the Eurozone. They're all measured differently. Now, what we've done is we've tried to say, what is CPI? In a normal relationship, how does it work? It leads to higher interest rates or lower interest rates. It's one of these indicators that we use to try to forecast what is the Fed likely to do, and therefore what's the value of the dollar likely to be. However, it has these 3 big problems. You can't compare it to CPIs of other economies. You can't. It does not account very effectively, and it's on purpose kind of chopped up to make this analysis very difficult when you're experiencing price shocks, such as we are right now in the U.S. economy, which then breaks this relationship. And it's very subjective. I use the example of healthcare costs, which are double the amount of GDP as what they're accounted for in the basket, and that's merely one example of that. It's rampant throughout the CPI measure, particularly in housing costs, for example. That's one place that it really stands out. So the question is, well then, is it a completely valueless announcement? Well, yes and no. CPI itself has very limited value, especially in the short term. However, understanding how inflation works does have a lot of value. And it's not just the value of, well, perhaps it's just something that I account for, I watch from a risk management perspective. Maybe that's what it is. Well, it is that. But it's also something that we can use to design our investing strategies and to try to understand, well, where is the opportunity now and where might the opportunity be in the future, which is what we're going to be moving into here in the next section. because it's really something that we want to make sure that, like all fundamental analysis measures, and this can happen in any kind of analysis, technical or otherwise, it's really easy to overcomplicate it and to get distracted in these kinds of problems, in methodologies, in even in getting emotionally caught up in what's happening, because either you live in the United States and you're having to suffer with this problem, or you live outside the United States and you're probably suffering with this problem as the U.S. catches a cold and the rest of the world gets it through contagion. So we're going to be looking at how to simplify our analysis of inflation, how to try to understand what is it saying about financial conditions right now, and how can we use that in our investing today from a risk management perspective, as well as forecasting where the opportunities are for tomorrow.